Welcome to lesson 7 in the course series about asset allocation. And in this lesson, we'll talk about if we should invest in stocks or bonds. This is one of the questions that investors have always asked. Unfortunately, the answer has always been, it depends. But what does it depend on? Well, if you ask in a local bank, they would probably say that it depends on how risk averse you are. That is the classical approach to stocks versus bonds. And I think that is correct to some extent. This is based on the framework that we are talking about US Treasuries, and we consider them to be completely risk-free. Now let's keep the term risk-free in mind. Risk-free in this situation basically means that the US government will have to default to not meet their obligations and for you to collect your coupon dividend from holding the bond. It's not the same as saying it's a 100% impossible. I guess nothing in life is 100% anything. But for me, the treasury rate in the US is the best indicator for a risk-free investment. You might be thinking, what if you're living in India or you're living in Australia? Should I also be using the US Treasury rate, or should you be using a domestic rate instead? Well, we have to go back to the term risk-free. If you consider either the Australian or the Indian government to always be meeting the obligations, then that is what you should use. You might have heard the rule of thumb that you should own the same percentage of bonds as your age. Meaning if you're 40, you should have 40% of your portfolio in bonds, and if you're 60, you should have 60% in bonds. It's based on the idea that the older you get, the more you need fixed payments, and you cannot stand the volatility to the same extent. While there is some truth to that, I don't think we can really use that rule as a fixed rule, because we have to know the expected returns we can get from bonds and stocks before we can make that decision. So let's talk about the yield of bonds first. I would like to show you this page. The way to read this page, and it's completely free by the way, and I'll link to it in the show notes, you can see here that depending on how long you're willing to commit your money, you can see which return you can expect to get. The question is the return satisfactory for you? Well, if you plan on living on a stable income and that is sufficient for you, there's absolutely no reason why you shouldn't be holding a bond for the next 30 years. However, if you're looking to maximize your returns, you should beware of the interest rate risk you incur. If the rates go up right after you bought your bond, the value of that bond would be worth less. We'll talk about that later, but let's take a look at the yield of American stocks here. This page shows you the Shiller PE. The Shiller PE is a good indicator of how much the expected return is of the stock market. It's looking back at the past 10 years and then compare it to how much are you paying for that earnings today. The way to calculate the expected stock return is simply by dividing the current Shiller PE up into 1, and you have your expected return. So what you now need to consider is, would I take the risk of the current stock market with a potential downside? Of course, you also have potential upside. And then compare that to the steady stream of cash you'll get from a bond. And if you're a bond investor, assuming you don't need the cash inflow from the recurring coupon payments, would you be willing to take on the interest risk? As you can tell, it's not easy to give you a rule of thumb. It really all depends on you as an investor, what you prefer, where you are in life, and if you do need that steady stream of coupon payments from the bond. If you do need the steady stream of coupon payments, I do recommend that you watch video 4 in this course series about asset allocations, where I talk about dividend stocks. And you can then compare dividend stocks to the potential yield you can get from bonds. Also, please keep in mind that for both stocks and bonds, the expected yields keeps changing. So make sure to regularly check up on the numbers before making a decision about how to allocate your portfolio. The next thing I would like to talk about is the correlation between stocks and bonds, or perhaps said better, the negative correlation between stocks and bonds. One of the most important arguments to why you want both stocks and bonds in your portfolio is that when one asset class performs poorly, the other asset class typically performs well. This was best exemplified during the financial crisis in 2008, where stocks dropped 37% while bonds went up by 42%. They do not always have a negative correlation. Though if you look over decades, there is a strong relationship that is what will happen over time. You can think about it like this. When the stock market crashes, the Fed cut rates rapidly to hold a hand on the stock market and the general economy. When rates are cut, the current holder of long-term bonds are similarly rewarded with a higher value of the bonds, since everyone in the marketplace can now get a lower rate while you have a higher rate on your bonds. To provide more context to the mechanism behind stocks and bonds, consider this. The interest rate is the price of money, so to speak. And when you have an economic crash, you'll see that money suddenly becomes scarce. We all want to protect the capital that we have. That is regardless if we're individuals or if we're corporations. But it's not good for the economy as a whole. So the Fed will create money, so to speak, by lowering the interest rate and incentivize all of us to borrow money and spend it on consumption and reinvest the money we have to keep the wheels turning in the economy again. Alright guys, that was my thought process about how much stock and how much bond to allocate in your portfolio. I hope you find them useful.